Is NVIDIA still the king of AI chips in 2025? With rising competition, export restrictions, and rapidly shifting geopolitics, investors are asking whether NVDA remains a long-term buy, or if the golden age is fading. Today, we break down NVIDIA's fundamentals, margins, valuation, and the hottest news impacting the stock right now. NVIDIA dominates the global AI semiconductor space. Its GPUs power more than 90% of AI training workloads in cloud and hyperscale data centers worldwide. The company has built a deeply entrenched ecosystem around CUDA, a software stack that makes switching away from NVIDIA expensive and difficult for developers. In short, NVIDIA is not just a chip company. It is the backbone of modern AI infrastructure. NVIDIA continues posting industry-leading profitability numbers. Let's look at the fundamentals. Gross margin, around 70%, operating margin, 58% to 63%. Net profit margin, roughly 53% return on equity, extremely high, reflecting efficient capital deployment. These margins are far superior to most semiconductor peers and reflect NVIDIA's pricing power and demand strength across AI, cloud, and high-performance computing. On the cash flow side, the company generates strong free cash flow, giving it the ability to invest aggressively in R&D while buying back shares. Now let's talk valuation, one of the most important points for long-term investors. Trailing PE. Approximately 42 to 44 times earnings. Forward, PE, around 24 to 38 times. PE ratio, 0.7 to 0.8, suggesting the valuation is reasonable compared to growth expectations. Interestingly, today's valuation is not far above industry averages when factoring in earnings growth. And compared with NVIDIA's own history, today's multiple is actually lower than its long-term average. While NVIDIA is not a cheap stock, it is priced for strong growth, and the fundamentals continue to support that expectation. Despite its strengths, NVIDIA faces several major risks that investors must understand. New U.S. export rules continue impacting NVIDIA's ability to sell advanced chips to China. Approval cycles may stretch as long as 30 months, delaying revenue and causing uncertainty. Chinese chip makers, AMD, and even cloud giants like Amazon and Google are creating competing AI chips. These alternatives could pressure NVIDIA's market share and margins. Headlines around politics or export approvals can move NVIDIA's stock sharply, sometimes in a single day. For long-term investors, these risks matter, but they do not change the fact that NVIDIA's technology lead remains significant. Looking forward, NVIDIA's growth story remains compelling. Artificial intelligence computing demand continues to surge, especially in cloud and enterprise sectors. NVIDIA's H200 and next-gen GPU lineup show strong order momentum. The company is expanding into robotics, autonomous driving, AI-powered simulation, and digital twins. Hardware, software, and CUDA ecosystem dominates competitors, reinforcing a powerful network effect. If AI remains the defining technology of the decade, NVIDIA is positioned at the center of that transformation. So, is NVIDIA a good long-term investment today? Strengths: category leading, AI hardware, best-in-class margins and cash flow, strong ecosystem lock-in, continuous innovation and product demand. Risks: geopolitical headwinds, especially with China. Increasing AI chip competition, high valuation relative to traditional metrics. For long-term investors who can tolerate volatility, NVIDIA remains one of the highest conviction AI plays in the market. Its fundamentals, competitive moat, and growth trajectory make it a strong candidate for a 5 to 10-year portfolio, but expect significant short-term price swings. If you found this NVIDIA breakdown helpful, please like the video, subscribe, and share it with other investors. Comment below if you want a deep dive analysis on AMD, Microsoft, Broadcom, or Meta next. Thanks for watching and see you in the next video.